Okay, so this question is a past exam paper. So it's a question that was examined in 2015. It's a good question. So as we mentioned that the first thing you need to know on every group accounts question, you must understand what you're being asked to calculate. So go down and see the requirement. What is the requirement? You are required to do what? To calculate number one, the goodwill, which is 7 marks, very easy 7 marks. And then also see the reporting date. The reporting date is 30 September 2024. You must see the reporting date because it's going to help you to know how to consolidate, how many months are you going to consolidate. Then also know what you're consolidating. You're consolidating profit or loss for the year ending 30 September 2024. So this date, 30 September 2024, the reporting date is extremely important because usually the only trick that the examiner puts in a income statement group accounts question is the months. The examiner will not give you a full year, is going to give you a party acquisition where they acquired a subsidiary during the year. You see, huh? So here, these are free marks, Daniel, here. So what you do here, before you read any note, please use the Lusambo way. The Lusambo way is the free way. Before you read any note, see, just put this line here, forget about this guy for now, the associate. You see, for now, we forget the associate guy. We don't care so much about the associate guy because we are going to give the associate guy some time later, but not now. Now is not the time for us to be thinking about this associate guy. It's just going to waste our time. Okay, so what do you do here? What you do here, simply copy and paste everything the way they are. Look, even the format, just copy and paste things the way they are. Get this figure plus this figure plus that figure, get these figures the way they are, copy and paste them. Now, before you do that, before you begin to copy and paste, there's one thing you must understand. You must understand the date of acquisition. When are they acquiring this guy? Now, see, you've been told here that this guy was acquired when? This guy was acquired on 1st of April 2024. You see that?
Yes, sir.
So before you start pasting the free marks, know the dates. Because if you don't know the dates, you start pasting things, you're going to waste time. So you know this guy was acquired on 1st of April because we've been told this guy was acquired on 1st of April 2024. And then you know the reporting date is 3rd September 2024, the same year. So from April 1 to September 30th, how many months are those? How many months are we talking about?
6.
6 months, you see? So now this means that you are going to copy and paste. For the parents, you copy everything in full, the way they are. Have you seen now? You copy and paste for the parents in full, the way they are. Now, what else do you do once you copy and paste? Once you copy and paste for the parent, for the subsidiary, what do? You also copy and paste, but this time around you multiply by 12, by 6 over 12 to show that this was acquired 6 months down the line. Have you seen that? Yes. Because they've told you that, yes?
The heading.
Which
is
heading?
It, like since they're saying that prepare a consolidated statement of profit or loss, so I can just come up with my own, like consolidated statement of profit or loss for U-based group for the year ending
No, this one is a free
September.
mark. This one, all you have to do, copy it the way it is. You write consolidated statement of profit or loss for U-based group for the year to 31st September 2024. Full stop. Just copy the question the way the examiners put it.
Yeah.
Only that you are not going to include prepare. But just copy it the way it is. Consolidated statement of profit or loss for U-based group for the year ended for the year to 31st September 20. This is 1 mark. Just copy and paste it. Okay. So let's start doing the work now. So as we said, we're going to follow the same format. So I'm hoping that you have the question. I've sent for the question on WhatsApp. So you have the question.
Yes,
so you should be following. So we're going to copy the format the way it is. We're not going to stress. We are simply going to copy the format the way it is. You see, revenue, cost of sales, gross profit, operating expense, operating profit, interest payable. Now you see, there is this figure called the profit before what? Profit before tax. Remember what we said the last time, how you bring in the associates figure. The associates profit now is going to come package up after interest expense, profit before tax. You're going to insert the associates what share of profit. So we can tax the profit and then we can have our figure. So let's go. Let's paste the free marks. Please remember here, group accounts, the only way you survive is if you use the Lusambo way. The Lusambo way is the free way. Do not waste time in the exam. Always go with the Lusambo way. Okay, so there we go. So we've got number 1, we write U-based consolidated statement of profit or loss for the year to blah, 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 blah. You write in full. Boom, the examiner gives you 1 mark. Okay, then we start. This is an income statement we are preparing. So what do? Revenue as always. Revenue. Now take a long time. After revenue, what comes next? Cost of sales. Okay, cost of sales. We are even relaxed at this point. What comes next after cost of sales? Yes, we have the gross profit. Mwademba, gross profit. We are even relaxed at this point. What else do you have after the gross profit? The format says we have operating expenses. We are simply copying things the way they are. Have you seen? So the operating expenses. After that operating expenses, what else do you have here? You have the finance costs. You see? Everything the way they are. Finance costs. You're simply copying and pasting. After finance costs, remember what we said? This is where you bring in the what? The share of associates profit. Have you said? You bring the share of associate. Why? This is because now the associate, this is because we also need to tax money from the associate. Have you seen? We need to pay tax. That makes sense. And then what do? You can now bring in what we are going to call profit before tax. Profit before tax. And then what do? You can now bring in the tax. Charge the tax. Once you charge the tax.
How about the interest expense?
The interest expense is the finance cost.
Oh, okay.
Yes,
so
finance
then
cost.
there is one which is operating profit. We have operating expense and operating profit.
Yeah, if you want, you can add them up and get the operating profit figure. It's okay. The examiner will still be, but it will not give you more marks for doing that.
Okay.
Yeah, if you want, you can add the operating profit. It's okay. It's up to you, but it won't give you any more marks. So there we have, when you charge tax, what you have now, we are going to have our profit for the year, which is our net profit. You see? Now, after our net profit, now there, when we have our net profit, what do? We now say profit attributable to, so now bring in this guy, profit attributable to who? Profit attributable to, of course, we know it's to the owners of the business. That's what we do. Always we give the owners of the business. So we simply say owners. Who are the owners? Owners of what? Owners of parent. They're the ones who get the profit. And then after we do that, what do? Then we bring in the non-controlling interest. Because this guy is not our guy. So the non-controlling interest, this is where we bring the non-controlling interest. Now, non-controlling interest is going to suffer a number of things, as we are going to see. So now let's begin to post figures here. At this point, you are even happy. So now you know you are posting figures for the parent and also for the subsidiary. So what was the revenue for the parent? For the parent, the revenue in full, it was 225 million. Have you seen that?
Yes, sir.
Plus, this time on, what do? You open your brackets and you do this. When you open your brackets, you bring in the figure for the subsidiary. Revenue for the sub was 122 million, 122.1 million. You see? Now, this one, we are multiplying by how many months? 6 over 12. Because that's when this guy was acquired. This guy was acquired 6 months before we reported. So we only consolidate, we are only going to consolidate the part that we've been with this guy. Because before we acquired this guy, it was not our business. It was none of our business. Are you seeing that?
Yes, sir.
So there you put that. Next, you go to the cost of sales. What were the cost of sales figure for the parent? I think it may be not. Okay, yeah, the cost of sales for the parents are here. How much we have for the parent?
142.
We have 142.2 million plus. We open our brackets. What do? We bring for the sub 59.1. You see, we are simply picking figures the way they are. 59.1. Then we multiply by 6 over 12. Next, the gross profit. Now, the gross profit, we are not going to bring the gross profit because we have to do some workings there. We are going to have some plus and minus as we go. So we're not going to bring in the gross profit at this point. We'll simply let it. Then we jump. We go to get our operating expense. Now, there is always a guy who has no idea where numbers are coming from. So for those who are following us online, the numbers are coming from me. So we're simply copying and pasting. Still, the operating expenses, what are we doing? We are going to copy this. For the parent, all of it. For the subsidiary, we also get all of it, but we multiply by how much? By 6 months over 12. So that's what we are going to do. Yeah, so that's what we are going to do. So we are copying these figures. We've copied this one, all of it. We've copied this one, all of it. But these figures for the subsidiary, we are multiplying by 6 months over 12. So now we go to operating expenses. We copy the 31.44 in full for the parent. For the subsidiary there, what do? We are going to get the 27, then we multiply by 6 over 12. And then the show goes on. We copy the interest in full for the parent. We copy the tax income in full for the parent. For the subsidiary, we are going to be multiplying by 6 months over 12, 6 over 12, 6 over 12. That's how you get the free marks.
On the interest expense, there's no working because we don't have anything for still base.
Yes, so on the interest expense for the subsidiary, we're not going to do anything because we're simply here. We have this one for the parent. For the sub, we have nothing. So let's go and paste the free marks. Group accounts these are the things that make people pass the exam. If you have a problem with group accounts, you should feel so sad because these are the easy marks. There we go. We have operating expense. We pick the 31.44 plus for the subsidiary, of course, in brackets because the 6 over 12. We have the 27 million, which are going to multiply by 6 months over 12. We close the brackets. Then finance cost, yes. How much do we have for the parent finance cost? Finance cost, we have 0.5. What should I push up, Daniel? This is the one you're asking about. Now, you see, the finance cost for the parent, for the parent, we get all of it, the 6 months over 12. Now, here there is going to be a working here on the finance cost. The reason is simple. Because the subsidiary also in the question, we are going to discover something here. Let me just take you back to the question so that you see what I mean here. We're not going to close it. We are going to leave it because there is some form of expense to be paid. Have you seen? 10% loan notes. Have you seen? There's a loan, 10% loan note. So there's going to be some interest. You see? There's going to be some interest there. That 10% loan note, we're going to establish how much of that 10% loan note. We're going to establish some form of interest that was paid by the subsidiary. So that interest we can come and now remove from the total interest that was paid by the parent. So we are going to do a working here as we go. Just see, remember that there's 10%. Now 10% of how much? You see? So we are going to do that one. Okay, so we can now move on. We can continue with the show of the free marks. We can continue with the show of the free marks. Okay, so where is our show? Our show continues. Where are we now? Now we are on tax, because profit before tax, we are not going to work it out. We need to do some plus and minus. Let's bring the income tax. We're going to pick this guy out of it for the parent. And then this guy, we want to pick 6 months. Have you seen? So what do we do? Yes, there we go. So we go to the associate profit share. We're going to jump it. There's a working here. We're going to do a working there on the associate. There's a working here. Even here, we're going to do a working. Gross profit is going to be a total of whatever we're going to work out per first up. Profit before tax, of course, here there's going to be a working. We don't have profit before tax because we need to come and add up things. Tax income, yes. Now we can get for the parent. So for the parent, what was the tax for the parent? The parent had paid total tax of how much? Of 14.4 million. Then this one, the tax that was paid, we also add what the sub paid. Subsidiary paid 9 million multiplied by 6 months over 12. We get the share. Okay, so now there we go. So now we have acquired all those figures. Those are free marks in the exam. Okay, so what else do we do? As you know, the non-controlling interest here, we need to look for the percentage of non-controlling interest, and then we're going to add there. So there, now let's do the work. So as usual, the first working under group accounts is group structure. So working one. Working number one is simply our group structure. Now, these are the free marks in the exam. If you mess up group accounts in the exam, let me say that if you mess up this one, there's a higher chance that you will not make it. Because also the examiner there has things that he wants students to know before they can go and get their employments. So we need to understand the group accounts part. Okay, so now for us to work out the group structure, we need to read things here. Have you seen? We need to do a bit of reading. Of course, we know there are 3 companies that have been talked about, but let's go and do some reading, then we can work out our group structure. Okay, so there we go. What have we been told here? Here's what we've been told. We've been told that this parent Steel-based guy purchased how many shares? 22.5 million shares of Steel-based. And see this guy, he purchased 22.5 million shares of Steel-based and 6 million shares of which one?
Asbestos.
Of this asbestos guy. Have you seen? He purchased 6 million of the asbestos guy. Okay, so at the same date, 1st April 2024. Details of the purchase, considering given consideration given at that date of purchase are: number one, investment is Steel-based. Still base is this guy is the subsidiary. So what do we do? We go here. There's a share exchange. Have you seen? Of two shares in still base in Hill base for every 3 shares in still base. Now see, there's this guy plus an issue to the shareholders of still base of 10% loan notes. You see?
Yes.
On the basis of 80 million kwacha loan notes for every 300 shares held in still base. You see, when we did, remember what we did on the considerations?
Yes.
So to have the two consideration, we're going to add the two considerations, the two forms of payments. The first one is the share exchange payment. And then the second one that we are going to do is a 10% loan note. Okay. So here, these things are straightforward. Remember what we said yesterday. When they tell you that he acquired how many shares, simply get the English, so it is, he purchased how many shares? 22.5 million shares. Simply bring, he purchased 22.5 million shares. Have you seen that? In a share exchange of how many shares? Of
3 shares.
No.
2 shares.
2 for every.
2 shares.
2 for every
shares.
3. Are you seeing? 2 for every 3. So just put 2 over 3. And then that's 2 for every 3 shares. Okay, so now we know 2 for every 3 shares. So if you want, you can even multiply by the price. You look for the price. How much was the price? So you've been told that the loan is redeemable at par, blah, blah, blah. Okay, we don't care. At least not for now. Then we can go, what was the share price? A share exchange of 3 shares in Hill base for every 4 shares in us base, plus a 1 quarter share acquired in cash. The market price of Hill base share at 1st April 2024 was this figure, 6 million, 6 quarter per share. Have you seen? So if you want to even come and multiply, because the parent now is the one that is buying. You use the price for the parent, the one that is buying. You see, 6 kwacha a share. Have you seen? So you can come and multiply those shares by the 6 kwacha. This is going to give you how much?
90 million.
90 million. You have 90 million. But you see, I like knowing how many shares were acquired, because it's going to help you somehow to know the premium. Have you seen?
Okay.
So how many shares were acquired? What do you think? 22.5 million shares multiplied by 2 over 3. How many shares are we talking about? How many shares are these?
15.
15,000 shares? 15 million shares, huh?
15 million shares.
Okay, so they acquired 15 million shares. Okay. We are going to use that later on to help us find out the share premium, because we have to look at the SFP to see the share price. We need to go and look at the SFP share. So let's start our working. Let's go to our board there and do our working. So here, what we are simply doing here, of course, we have our group structure here, which means we've got still base, and then we've got has base. This is Hill base. The parent is Hill base.
Yes, sir.
Okay, so we've got the parent, who is the Hill base guy, and then we've got the subsidiary, who is the still base guy, and then we've got the associate, who is the as base guy. Okay, so what we want to establish here, we want to establish the percentage that this guy acquired. Is it 20%? Is it 90%? Is it 100%? So what we know now is this. What we know so far is that this guy, the as-based guy, the EU-based guy, he acquired 22.5 million shares in a share exchange of 2 for every 3, and the price at that date was this 6 kwacha per share. So now what we know is that he paid how much? He paid 90 million kwacha. And then what we know that this number here represents how many shares? 15 million shares.
15 million shares.
That's what we also know. This is 15 million shares. Okay. So now we need to know the percentage that this money acquired. How many shares in total were in still base? How many shares in total were in still base? Because now we know the number of shares that this man acquired. So look at the statements and tell me how many shares were there in total.
30 million.
There were 30 million shares. 30 million shares. Okay. So there we go. We have 30 million shares. So what we do to identify, to know whether this guy is a subsidiary, what percentage, there's a formula, and this is the formula I'm going to give you. You simply get, you're going to get acquired number of shares. Have you seen that? The acquired shares over total shares multiplied by 100. What were the acquired number of shares? He acquired 22.5 million. What was the total number of shares available? 30 million multiplied by 100. So he acquired what percentage? 75%.
Yes, sir.
So what do? That means you know that this guy is a 75% subsidiary, which means the NCI is how much? Is 25% NCI. So now you know the non-controlling interest is 25% because it controls 75%. And when we said control, we meant power to direct activities. When we said activities, we meant the financial and operating activities, not just common activities like sweeping, directing who is going to sweep, no, financial part and the operating part. Okay, so there we go. So are you following at this point, Daniel?
Yes, sir.
Okay, so now we know that this guy is 75% subsidiary, and we also know how much this guy was bought at. Now, what we need to establish also is another payment because he paid 90 million, but remember there was another payment which he made. So let's go and fish it out also. What is the value of the other payment that he made? So we deal with this guy once and for all. Okay, so there we go. We've been told we're coming back to the associate later. Let's deal with the subsidiary first. We've been told here that a share exchange of 2 shares in Hillbase for every 3 shares in Stillbase plus an issue, you see, to the shareholders of Stillbase of 10% loan notes. Ooh, 10% loan notes on the basis of 80 million kwacha loan notes for every 300 shares. See, get the English the way it comes. Have you seen that? 10% loan notes. Have you seen? Now, here's what you're going to do. What you are being told is this. What was the share price anyway? Before we even go. Oh, the share price was 1 kwacha. So we know a premium was how much? Was 5 kwacha per share. Okay. So let's go. So there we go. Here's what you're going to do, Daniel. Let's follow the English the way it has come. Here, we are being told here that 10% loan notes on the basis of 80 million kwacha, 80 kwacha loan notes for every what? Every 300 shares held in Stillbase. Every 300 shares. See, we said for every 3. You remember? For every 3. What did we do with the every 3? We put the 3 as a denominator. Okay. So here we simply get here what we are going to do here is very, very straightforward. For us to ascertain the value, we are simply going to get a 10% loan note. Now, this 10% loan note here is what we're going to do. We're going to get a 10% loan note. The 10% loan note was paid. So this 10% we are simply going to do something like this. 10% loan note is here. And then we multiply by these guys, 22.5 million shares, the one that he acquired. And then we are told that for every how many shares? For every 300 shares held by this guy, at a price of how much? At a price of a quarter, 80 million was to be paid. You see?
Yes, sir.
He acquired how much? 22.5 million. But we are told for every 300 shares he holds, there's a 10% loan note on the basis of how much? 80 kwacha. Are you seeing? So we multiply. How much figure are we getting there? How much money are we getting is supposed to add on?
It's 6, then by 10%, it's 3.6.
Very good, very good. So we are going to have 6. Have you seen? Now, this 6 million kwacha we are going to have here, the 6 million is going to be added to the 90 million, the one that we found at first, which means the total amount of money he paid to acquire this guy, he paid 96. That was the consideration. Now remember, this 10% is not a decoration, as you have said. It means that these guys, they paid interest to the shareholders of the subsidiary of 10% of this amount, which is how much? 10% of 6, 3.6. Okay, 3.6.
Yes, sir.
Okay, 10% of that is you are saying is 3.6. Okay, now that 3.6, we are just going to take it to the income statement. But the thing is this, let's go to the income statement and see. When we're going to multiply this by how many months? 6 months over 12. You see?
Okay.
That's the finance cost you're going to share. So let's go. So there we go. So now we add another amount. We're going to say the other amount was the other amount here was this is possibly not one of my best formats, but for the purpose of this question, I think it's fine. So the other payment was a loan note, and we've been told that a loan note it was in brackets we have 22.5 over the 300 shares. Then we multiplied by the 80. So what we had, then we multiplied also by, when we multiplied by 80, we had how much? We had 6 million. We had 6 million. So there we go. So the new price there is 6 million. Okay, so we have 6 million. Okay. Now we've been told here that that 6 million, remember this was a 10% loan note. The 10% loan note are going to multiply the 6 million when we are going to go here. On the interest, we're going to say now there's a working year. So we're going to say that interest, we're going to remove what was paid already. Because the total amount of interest the parent paid is this guy. So in this total, there's what they paid already to the shareholders of this other company. So what do we do? We remove it first. So we're going to open brackets. We say 6 million multiplied by 6 months over 12. Have you seen that?
Yes, sir.
6 million multiplied by 6 months over 12. And then the answer we multiply by the 10%. Because we are not going to get, see what we did to the question today. When we are solving, yes, we multiplied 10% with 6 million. No, it's not supposed to be like this. We're not supposed to get 10% of those 6 million because we just acquired this guy partly during the year. We first have to bring it to 6 months. And then what remains we multiply by 10%. 10%. So at the figure that we're going to find, we remove from the total amount that the parent paid.
Okay.
Okay, so what figure are we talking about there?
It's 1.8.
1.8, which means we're going to remove 1.8 from this figure here. We're going to remove 1.8. So we're going to have a figure somewhere there of the interest that they paid. Are you following?
So what? It's not It's not 1.8.
It's how much?
0.3.
0.3. Okay. So we are going to remove 0.3. So the answer that we are going to find when we multiply those figures is 0.3. 0.3. So this figure we're going to remove from that figure because they already paid it. We remove the one that we remove the one that does not belong to that's 0.3 there. So we're going to remove it from the 0.51 to get our figure. Okay, now see. So the total figure is how much for interest?
0.21.
0.21. So that was the total amount of interest paid. They paid is 0.21. That's how you do it every single time. Okay, next, what else do we have there? We have dealt with the investments. We are still on the structure. So we can go back and get something else again. So it seems we have dealt with the structure, the group structure. Now, if we want, I would love us to also deal with the investment in the associate, so that we forget about the associate. So I would like us also do with the investment in the associate, so that we forget. The associate is what percent? The associate. The associate is what percent? The associate is what percent? How much did they acquire the associate? Okay, investment in ASBase. You see, the associate ASBase. So here we have a share exchange of 3 shares in new base for every 4. You see? 3 for every 4. 3 over 4.
4.
Have you seen that?
Yes.
Plus 1 kwacha per share acquired in cash. You see?
Yes.
Plus 1 kwacha per share acquired in cash. Have you seen? So here, what do we do? How do we know the percentage? So let's find out the number of shares that they acquired for us to know the percentage that they acquired. Have you seen? Look at the number of shares in this guy, in this ASBase guy. ASBase had how many shares? 15 million
shares.
Now see, we are saying it is 15 million shares because it is 1 kwacha per share. Have you seen that price there?
Yes, sir.
If it was 0.5 kwacha per share, they are not going to be 15 million shares. Because when you multiply 1 kwacha per share, we multiply that 1 by 15, it will still give you 15. But if you multiply 0.5 by 15, it won't give you 15. Have you seen that? You must be careful in the exam. We are saying that 15 million shares because it is 1 kwacha per share. This is money here, it is not shares. Have you seen?
Sure.
Yes. Remember that. Very, very important to remember. Okay, so there we go. We can do the work. This guy had 15 million shares. So how many shares did we acquire from this guy? This guy had 15 million shares. Let's find out how many shares we acquired in this guy. Since he had 15 million shares, now there we go. We acquired the 3 shares in his two base for every 4 shares in ASBase. So how many shares did this guy acquire?
Okay, so it's 60 by 3 over 4. 45.
He acquired how many shares?
45 shares.
He acquired 45 shares.
I did 60 since they're saying that.
Where are you getting the 60?
Hubers purchased still base and 6 million shares of ASBase.
Yes, they have told us here that this guy, he purchased 6 million shares. You see? Here,
yes, sir.
He purchased 6 million shares of the associate. Now, what we are saying is this. The associate had the total number of shares of how much? 15. So we simply say he purchased 6 million shares. Have you seen? Then yes, what was the total number of shares that this guy had? He had 15 million shares. Have you seen?
Yes, sir.
Then when we multiply that one by 100, what is the percentage you are getting? 40%.
Yes, sir.
See?
40%.
So the investment in a subsidiary is what percent? Is 40%. So if you want, you can know the number of shares that you purchased by simply getting that the same thing that we did, 6 multiplied by 3/4. Then we multiply by the purchase price or whatever it is. Whatever purchase price this guy was using, you can check it out, the purchase price for the subsidiary or for the associate or whatever. But for now, before you go there, let's deal with what we've done with. Then we'll talk about the other one later. Okay, so we can go. Okay, there we go. Let's go to our working space and let's put this guy in motion. So now we've got investment in, so the percentage for here, we know it's 40% for the associate. Have you seen? Now we've got a working number 2, a small working. This one we are calling it investment, where in ASBES. ASBES sounds like an insult, huh? This examiner was a very serious one. To tell you that if you fail to answer this question, then you know what you are. He was a very serious examiner. He was a good guy. I like this examiner. He's good. The Zika examiner is very serious, huh? He names the question ASBES, so that you should know what you are if you can't answer. Yeah, and you know, I wouldn't blame this examiner because these questions are extremely easy. They're extremely easy. Okay, so investment there, what we have, we've got the number of shares that he purchased, of course. The investment in the subsidiary, we've got 6 million shares, which he purchased. The 6 million, we say 6 million shares. We divide those 6 million shares by how much? By the number of shares, the 15 million shares, and then, of course, we are going to multiply those by 100% so that we get our 40%. Please show these workings up. Don't work them out in the question paper and then forget to put them in the answer sheets. No, work them out in the answer sheet so that the examiner can come and see what you did. So yeah, I want to ask you a question. Huh? How much money did this guy pay for this, for the associate?
For the associate.
How much money did he pay?
6 kwacha.
He paid how much for the associate? He was paying how much?
Are we going to get the same amount like we did at first for steel base? Because for steel base we used 6 kwacha per share. So I'm assuming even for ASBES we are going to use 6 kwacha per share.
Okay, so if we use 6 kwacha per share for ASBES, how much money are we talking about?
Sure.
How much money are we talking about that he invested in the subsidiary, in the associate?
36 million.
20?
36 million.
36 million. There's no way he can spend 36 million. How?
Since he acquired 6 million shares,
okay,
then by 6 kwacha per share.
No, he acquired 6 million shares in a share exchange of 3 shares for every 4.
All right.
Okay. So how much are we talking about? 27 million. Okay. That's the investment he made in the associate. Please remember that. Make no mistake. So now you are done with that simple working there. So now what do we do? Now we can do our next working, which is simply our net asset list. Of course, there are some other consolidation adjustments. I like doing the consolidation adjustments first, and then I go to the net asset list. So if you want, we can do the consolidation adjustments. Let me just write here and say consolidation adjustments. Maybe let's do them from here. Let's just say consolidation adjustments, including what we are from doing is consolidation adjustments, one that we are called investments in subsidiary and in what. So we have another customer working number 3. This time around, we are going to read the note. Okay. Of course, the other free marks that you can get, but let's just do the other workings. So what do we do? Let's go to the notes. The beauty about these questions that they are always 3 marks. So we have a note here. See, we are done with the investments in both. So the first note that we are going to have is this guy. Okay. Note number 1, the details of the company's capital reserves at 1st October 2023 was that. Okay. We don't care so much because we know this is coming to work for the net assets. We're going to use these guys. Okay, so now let's do the note. Note number 2 says, a fair value exercise was carried out for Stillbase at the date of acquisition, which revealed that its land had a carrying amount, you see, less than its fair value. You see, what is this code when we did IAS 36? When the carrying amount is less than the fair value, what do we say? What is that?
The asset has been impaired.
Is it true that we said when the carrying amount is less than the fair value, then the asset has been impaired? We didn't say that.
Then there's a loss.
We said the opposite. We said impairment is when does impairment happen?
Impairment is when the asset has lost some value. When the assets have gained some value.
Impairment, we said, is when the carrying amount of an asset. Have you seen that?
Yes, sir.
In your books, your CV, let's say in your books, let me give you this example. Here, what we said was this: in your books, your CV is equal to 80,000 of this particular item. Have you seen? You go to the market, yes, the fair value is equal to 60,000. Have you seen? There's a difference here of how much? 20,000. This 20,000 is an impairment loss because the asset has lost value. In your books, it is supposed to be 8, but the market value, the fair value today is how much? 60. It has lost value. In this question, we are being told that the fair value was 9 million higher than the CV. Have you seen? Fair value is higher than the CV, meaning there's a gain.
Okay.
Have you seen?
Yes, sir.
There was a gain here in this question. There was a gain. So what do we do? When there is a gain, it means depreciation must be revised. See what we said? Okay. We said when there's a gain, there's a valuation, the depreciation should be based on the new what? On the new value.
On the new value.
Because if we keep charging deep on the lower value, it means we are undercharging what? Deep. So here, let's say, let's call this one fair value adjustment. Fair value adjustment working. What do you do here? We've been taught that this asset, when was it? When was the acquisition? You can simply bring it, say here at acquisition. If you want, you can use this format, and then you can also show the movement, which is simply the difference Or if you want, you can also now show at report. What happened at report? So this guy had got different kinds of assets. So let's go to the question and pick it up. One thing we know is that at acquisition, when we acquired, we discovered that that asset was 9 million higher than the fair value. That means even at report, because we don't have the information when they were, we don't have information that tells us the amount of this asset. All we know that the fair value, the carrying amount was less than its fair value by 9, meaning the fair value was higher than the carrying amount by 9, which means this is a gain of 9 million. So simply show a gain for now. Then we are being told here, wow, its plant had a fair value more than its carrying amount by how much? By 15.
15.
You see? So land, we've been told here that an item of land, this land increased in value by 9, and then a plant increased in value by how much? By 15. Now there's a rule here. Here, there's a rule. Here on the movement, if you want, you can simply say depreciation or whatever, because land does not depreciate. So what do we do here? We put new. Have you seen? Land does not depreciate. This is how come you've seen. We just said if the value increased by 9, we don't depreciate land. So even at report was what? It was 9. But look at the plant. The plant, we are told it increased by how much? By 15. So this is our land here, and this is our plant. The plant increased by 15. So what is the movement? Was this supposed to be 15 even at report? No. We're supposed to do a simple working here to show the true value at the date of report. So what is the true value of the plant at the date of report? That's the question. What do you think we are going to do? What do you think we're going to do? Okay, let's go back to the question. Yeah, that is true. So let's go back to the question and let's look at our figures again. See, the increase in fair value of plant would create additional
depreciation
of how much?
1.5 million.
In the post-acquisition period. In the consolidated statement of financial position at 30 September, blah, 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 blah. Of course, we know. So what do? We go and show that DIP, because the asset has increased in value, even DIP was also increased in value. So what do? The DIP is 1.5. Land does not depreciate. So here we have 13.5. Total here we have about 24. So the fair value adjustment in total increased by 24, that was the total. However, DIP, we had DIP of how much? Of 1.5, which means at the date of report, our assets, the real value is going to be 22.5. Now, there's an important point I want to make here. When dealing with the net asset list, on the format, there's the part, you remember the fair value adjustment part on the net asset list. You're going to pick this 24. All of it, the full fair value adjustment total, 9 plus 15, you have 24. This is the figure you're going to send to the net asset list at acquisition. Because at the date of acquisition, this was the value, the 24 was the true value. At report, this was the value. So at acquisition, permanent asset list, at acquisition, go and push the 24. Okay, are we okay?
Yes, sir.
So to save ourselves time, let's do the net asset list. The net asset list is working number 2, the big 2, net assets. Have you seen? Yes. The net asset list, you can simply say things such as you have something at at acquisition, then you have at report, and then you have the PAP, post acquisition profits. Something like that, or whatever the case is. I think let me just say PAP. Some use this spelling anyway. The format never changes here. What we do is simply bring the share capital. Never changes. Always the same.
What is the full
post-acquisition profit? PAP. Okay. Share capital. We bring the share premium. We bring in the retained earnings. After that, what do we do? Share capital, share premium, retained earnings. Then we bring the fair value adjustment. After that, what do? We bring in the excess dip, the depreciation, and then we bring the URP if the sub sold. And then you can bring in something that the examiner was going to tell us happened here. Maybe there was an item of plan that was discovered during the whatever it is, but for now, that's what we have. So to just make clear my point, I said that this figure here, the 24, comes exactly here at acquisition, the fair value adjustment. Then here, there's no dip. Here, there's no URP. We don't depreciate an item, we're just buying it. Have you seen? Dip is going to come where? At report here. That's when we're going to depreciate. Somewhere here. Have you seen?
Yes.
Yes. So that's how we got this figure and we took it there directly. So let's go another note. These are really good questions. Okay. So there we go. Another note says this, note number 3, it says, prior to its acquisition, Steelbase had been a good customer of Hubase in the post-acquisition period. Okay, see? Steelbase had been a good customer to Hubase. So here, the subsidiary is buying from the parent. Have you seen? Which means that URP will not affect the net assets. And realized profit will not affect the net asset because it is the subsidiary who is buying from the parent. But if the parent was buying from the subsidiary, the new RIP was going to be included at the net assets list at acquisition. Okay, so in the post-acquisition period, Hubase sold, the parent sold the subsidiary goods amounting to 30 million. Okay, they sold. So what do? Let's go. Hubase made a profit of 12 million on sales. Half of these goods were still in the inventory of Steelbase at 30 September 20X goods. So the parent sold the subsidiary goods worth 30 million and made a profit of how much? Of 12 million, meaning that this profit of 12 million, you know, it's like this. I love saying this here. Are you seeing that?
No.
Are you seeing the question?
Yes, I'm seeing the question.
Okay, so we are saying that this guy, the parent sold the subsidiary and made a profit of how much? Of 12 million. Now you see what to do when the parent sells. When the parent sells, get this 30 million, all of it, go and remove it from the sales revenue because you cannot sell to yourself and say you've made a profit. So go to the sales revenue figure and remove minus 30 million, all of it, because you cannot sell to yourself. Then what do you do again? Go to the cost of sales. Have you seen?
Yes, sir.
The cost of sales figure also, remove all of it. Are you okay?
Yes.
Okay. because the goods were worth 30 million, which they bought. So the cost of those goods were 30 million. So just remove all of it from the cost of sales. So you don't overstate the cost of sales. Remove it. Very, very straightforward indeed. Okay, so that means our first revenue figure, we are done with revenue figure. Okay, what else do we have? Now we have something here. We can now go back. What we are saying is, yes?
Is it possible that you can be given a situation whereby, since for instance here they've said in the post-acquisition period, okay, whereby like prior to its acquisition, Stillbase has been a good customer of Hillbase. Now, before like Hillbase acquired Stillbase, let's say it sold goods worth 60 million, and they said probably, let's say they bought those goods on credit, and within that period, Stillbase probably paid about 30 million. And after paying 30 million, Hillbase decided to buy, to acquire Stillbase before they even settled the credit which they had for 30 million.
Okay.
What can happen? Does it mean it can just be scrapped off, or?
When you acquire a company, you acquire both its what? Its assets
and liabilities.
Yes. Because you've bought. You cannot say, no, I'm just acquiring the assets. The liabilities are yours. Not acquire. You acquire everything because you control everything. Okay, so now here, because the parents sold, have you seen? Which means that because the parents sold, power has just gone. Let me just remove him from.
All right.
Power. Okay. Power has just left us. Okay. We are even almost done anyway. Okay, so there, let's go. So now here what we have is this. Here, that's 12 million. Remember, see what we are being told. Okay. Back again. Okay. So what we have here is this. We are being told that they made a profit of 12 million on these sales. Half of these goods were still in the inventories of Stillbase. See, half of 12 million goods. So meaning that from this 12 million, they're not supposed to make it. But they sold also to another person, so they made a profit of half. So the 6 million is genuine what? Is going to be genuine profit. But the other half, the other 6 million, we are going to reverse it. Have you seen the URP? So here's what we are going to do. We are going to say, to do a working here on the URP. URP, we are going to do a simple working also. We are going to call it, whatever we're going to call it. We can say working number 2, working number 3, another small 3, working number 3, this is number 3, so we can say 4, working number 4, and we simply say URP. So on the URP, the highest profit, these guys, they sold goods worth 30 million, and they made a profit of how much? Of 12. So the double point is going to be something like this. Double point, you're going to debit revenue by 30 million, which we have done already. Simply reduce the revenue. And at the same time, you're going to credit the cost of sales to also reduce it by 30 million. The next thing you're going to do, you're going to get, also you're going to debit. See, you are debiting the revenue here. a debiting revenue. Let me just write it proper just in case.
Okay.
Yeah. So we are going to debit revenue here. What we have done by 30 million. Also credit the cost of sales also by 30 million. Then the next thing you're going to do also, you are going to debit another double entry. You're going to debit the cost of sales by how much? By 6 million. Because they're going to say they made the profit of 12. Then half of these goods are still in inventory, meaning that the other half was sold. So the 6 million has remained in inventory. So what you're going to do, you're going to get this 6 million here. This 6 million profit should not be recognized. It should be removed. Have you seen? So what are we going to do? We are going to debit cost of sales by how much? By 6 million again. So we're going to debit cost of sales by 6 million. And then we are also going to credit inventories, to reduce inventories also by how much? By 6 million. The one that was, remember they sold something to an outsider. So we go to our workings there, and then we go to our inventory figure. So what do we do on the inventories? Now the inventories, as you know, it's on the SFP, not in the income statement. But the other 6 million, we are going to debit it in the cost of sales. Have you seen? To increase the cost of sales, because the other 6 was sold to an outsider. So we are supposed to increase the cost of what was sold by 6.
By 6.
And then the other 6 were supposed to go and reduce the inventories by 6 because they left the company, those goods. We're supposed to go and create the inventories. That's what we do there. Okay, there we go. Now remember, there was a dip there also on excess dip of how much? 1.5. So we add the dip to the cost of sales of how much? 1.5. You remember the excess dip?
Yes, sir.
On the movement, this figure goes to the cost of sales to increase the cost of sales. Unless the examiner tells you that it was charged somewhere else, then you can take it where the examiner tells you. Okay, is there anything else that we need to calculate here? I feel there is nothing. Now remember something here. This figure, the 1.5 million, is a dip. We are suffering dip, but so it goes to the cost of. So then again, this same 1.5 is supposed to go and affect the non-controlling interest, the NCI. The NCI also should suffer dip. Have you seen? Okay. We should not be paying dip alone, because the other guys also benefit. They get a profit also. Have you seen?
Yes, sir.
So they should also suffer the depreciation also, to be prudent. So what do we do? Now we can go and do our net assets list at acquisition, finish it off. So there we go. So it means URP, we have nothing because the parents sold. So there's no URP at acquisition. So URP, we still have nothing here. Have you seen? Okay, now let's go to the fair value adjustments. Let's go to the share capital. Share capital, how many shares did the subsidiary have? Only pick for the subsidiary. How many shares? The sub? How many shares?
30 million. 30
the subsidiary had how many shares? 30 million shares. Have you seen? 30 million shares. Yes, share premium, how much was it for the subsidiary?
12 million.
12 million. Retained earnings, how much was it at acquisition?
22.5 million.
Retained earnings for the subsidiary was 22.5 million. Now here, there is a calculation. You see? Retained earnings, you're saying how much was it?
22.5 million.
Okay, so there's a working, you're going to do something like this. These are the workings you must remember in the exam, they give you marks. So let's go to the thing and see retained earnings. See, retained earnings are profit for the total, the subsidiary made how much? Made 27. Have you seen? This 27. Now from this 27, which they made at the end of the year, what we are going to consolidate is only 6 months of this. Have you seen?
Yes, sir.
Because the other half, they made it before we came in.
Okay.
So what we are going to do is this. to find the tenant earnings at acquisition, we are going to get the $22.5 million that we've been given, the 22.5 million plus brackets 27 multiplied by 6/12, because the other half was before we acquired. So want to find out the total profit that they had before we acquired them. Have you seen?
Yes, sir.
So how much was the total profit they had before we acquired? Because before we acquired, they had something. How much?
36 million.
36 million. Yes, that's how much they had before we acquired them. So from this 27, we are simply picking up the half of 27 we add on what has been shown on the SFP. Because at the date of report, we are being told that at the date of report, what was available was 22.5 plus what they had at acquisition. So we remove here to be more prudent. So what do we do there? We simply now go and finish our work. The job is done. We even bring the retained earnings. Of course, we've got the 22.5 plus brackets 27 million multiplied by 6/12, which gives us a 36 million. And the total amount of money now that we have is how much? This guy plus this guy is 54, plus this guy is 90, plus this guy is 102. So we have 102 in total. Now this figure is very important because they're going to use it to work out our goodwill. You see? Yeah. If we are doing a consolidated statement of financial position, we're also going to bring figures here. For example, bring figures there, and then we also bring these other figures somewhere there. We bring figures here, and then we add up. We find the PAP. Then we use this figure to get the PAP, to get the NCI, and also to get the group retained earnings. We could have done that, but for the purpose of this question, we don't need to do those workings. So I'm not going to bother you with those. We have to just follow the same format that we do for consolidated, the one that there's a video on YouTube already. Actually, I've put some video on YouTube. We have to go and just watch them for the other parts. But in this question, we are going to restrict ourselves to this. So what do we do? Let's do our goodwill. So what is goodwill? So now for the purpose of this calculation, let me just rub now this part here and use it for working number big 3. Working number, the other 3 are here. I'm going to say working number 3, which is simply goodwill. Have you seen? So there we go. Yes. So goodwill, how do we got our goodwill? Goodwill, we simply say purchase price. Have you seen? Or simply say consideration. Now, the consideration here, we had 2. Have you seen? The first one that we had was the share exchange. Have you seen? Of where we paid 90 million. And then the second one, this was a share exchange here. This was a share exchange. The first one was a share exchange. We had the share exchange. And then the next one, it was an additional consideration. Huh? There was an additional consideration, a 10% loan note. Have you seen? 10% loan note of how much? 6 million. You see? Okay, so now in that case, what do? We now get the NCI. We add the NCI always at fair value. Okay, so what's the NCI fair value? This one is usually given in the question by the examiner. If it's not given, the examiner will give you the share price of the subsidiary, so you should work it out. But in this case, I've not seen any notes from the examiner. So what I'm gonna do is this. Simply go to the notes and look for the, okay, it is group's policy to value non-controlling interests at its fair value, which the director has determined to be how much? 29 million. So the fair value of NCI is 29 million. So the job is done here. What do? We even go to our NCI. We even put 29 million there. So we had, how much is our total? We have 135.
No, 125.
125, good. So we have 125 Then that 125, if we remove, see this figure here, we remove the net assets at what? At acquisition. You see, we remove the net assets at acquisition. How much was it? 102.
102.
So we are going to have our goodwill. Have you seen? Goodwill.
Yes, sir.
When at acquisition of how much?
23.
Of 23. That's the figure the examiner wanted you to give him. He said, give him the goodwill when at acquisition. But what we are going to do, we are going to finish it so that we show how it should be done at report. The first question said, calculate the goodwill arising on purchase. 7 marks. That's simple calculation, 7 marks. So what do we do? Now let's finish it up. So in other questions, especially the SFP questions, there are also going to be something called impairment. So we're going to bring in the goodwill impairment here. And then if there was some impairment, now here there's no, so we're going to say now goodwill at report, which is still how much? 23. This is the figure that goes to the SFP. But for most of this question, the examiner wanted you to end where? Wanted you to end at this figure because he told you goodwill arising from acquisition. So he wanted you to just end there. You get the free 7 marks. So now the question is done. So what do? We finish up the postings. So now we can go and do our full question. So now we need to post things here. So we have everything in place. Operating expenses, how much do we have?
No, it's 0.21.
Is there something in the notes that we must look at from the operating expenses? Is there something in the notes that suggests that we have to look at something? We have to make sure we, okay, here, note number 4. There's a note we've not done, note number 4. Been told an impairment test on the goodwill of steel base conducted on 30 September 2024 concluded that it should be written down by how much?
2.25 million.
Okay, so the impairment loss of goodwill. So the value of the investment in associate was impaired. Okay, we don't care that much. So this 2.5 million, remember when we go back to our working there, this 2.5 million in the income statement, we are going to treat it as what? As an operating loss. Have you seen?
Okay.
This is a loss, it's an operating loss. Goodwill was impaired. Okay.
Won't we add it back on the axis, or won't we less it from the goodwill at acquisition so that we get goodwill at report?
Yes, very good, very good. So there we go. What do? We are going to now also, operating expenses must go up by how much? By 2.25, it's an expense. So this means that for us to get the goodwill at reporter, what do?
Yes.
We simply come and raise the 2.25. Then we're going to have a goodwill of how much at report?
20.75.
20.75. Now remember, here we left the 2.25, so we're going to have the 20.75. Remember, this figure in this question is not needed. We're just showing that in case it was an SFP question, so what you could have done. Are you seeing that? But okay. This working and this working for this question, the examiner in this question just wants you to end here only. Okay, so there we go. So we are done with
I now get it, like goodwill at acquisition.
Yes, at acquisition. So there we go. So we can make our totals. What is the total for the first one for revenue? Our total for revenue, there for revenue we have 256.05. For cost of sales, we have 149.2. We less. Then we are going to have our sweetheart there. Our gross profit of 106. Okay, then when we add the operating expenses, we are going to have some figure here, 47.5. 0.19. This is an expense. Remember, it reduces the profits. And then also the finance cost, an expense, it reduces the profit. Now, see.
So on the cost of sales, it's supposed to be 147.75.
Cost of sales, 147.75.
Yes.
How? We have 30, we had 6, we had 1.5. It can't be 147.
Oh, okay. There's 1.5, huh?
It is 1.5.
I think I missed it.
Now we come to the part where we're supposed to add what? The share of profit for who? For the associate. So the associate also must share its profit. So that it can be taxed also. Have you seen? So
Yes.
What do we do? How much was the profit for the associate? Okay. We simply go and pick it up. How much is it for the associate, the profit? These are the simple calculations that you must do. For the associate, how much was the profit?
Is it 27 million?
Okay, retained earnings, okay. See, for the associate, how much was the profit? There we go, 12. See? 12 million.
Okay, we just get it the way it is.
We get it the way it is, the 12 million, but we get a percentage. We only get a percentage. What percentage is the associate? So we get the 12 million. Have you seen? We multiply by what's the percentage? Okay, let's do this. Before that, because we acquired 6 months down the line, we are going to say yes. The percentage for the associate is 40%. Then we multiply this by how much? By 12, which we multiplied by 6 over 12. How much? So first, multiply these two first, so you don't make a mistake. Multiply these two first, and then multiply by the 40%. How much are you getting?
I'm getting a 240.
Which is 2.4 million. So that's the profit. So when we add everything together, then what is our tax? What is our profit before tax?
Profit before tax.
This guy. What's our profit before tax?
The operating expense, that's 47, right?
Yes, for 7.19. So that's our operating profit. That's our profit before tax. And then what do? We charge the tax income. So how much is our tax income? How much is our tax income? 18.9. When we list, we have our net profit of how much? How much is our net? This guy?
It's 42.9.
Our net is 42.9. That's our net. You see? Now we share this profit. So what do we do? That's our net. So now we can say, see the non-controlling interest here. Non-controlling interest, what percentage was it? It was 25%.
It was 25%.
So this 25%, we said is supposed to suffer also depreciation. Depreciation. What was the figure for the non-controlling interest? The NCI.
It's 29. Oh no, that's not fair value. Yes, 29 million.
29 million, are you sure?
Yes, I got it from the goodwill calculation.
Okay.
NCI at fair value.
Okay. The NCI at fair value was that one here. Have you seen it? Okay, let's do this. Let's bring in the net profit. How much is our net profit?
It's 42.9.
Okay, now look at it this way. For 2.9, that's the profit attributed to owners. So we have our 42.9 for 2.9. Okay, so what do you think you're going to do that with for 2.9? What do you think we're going to do with a 42.9? Because we need to establish which figure is supposed to go to the owners of the business.
Okay.
You see, we don't, this profit, not everything belongs to us from this profit. You see,
Yes, sir.
it's not everything. Some other things belong. Let's go to the question and look at something here. It's not everything that belongs to us. Have you seen?
Yes, sir.
So the profit that this guy has made in a year was how much? Was 27.
27.
Have you seen that? But this 27, we do not control everything. Have you seen?
Yes, sir.
We do not control everything. So what do we do with the 27? Here's what we are going to do. We get that profit at 27. Remember, work with the profit given to you in the question. Huh? We are given the question here, you do that, you multiply the 25%, you multiply with these things in the brackets. You say the 27 which they made. So we simply acquired how much? 6 months. Multiply by the 6 months over 12 to get our share. And then what do we do? It also has got to suffer depreciation. Remember what we said? Also remove the 1.5. NCI should suffer dip also. So when you multiply those figures, how much are you getting? How much are you getting? Let me even write it a bit lower here. Let me write it a bit below so that it should be able to reflect. Okay, so there we go. We have so how much would we multiply? We've got the 25% there. We multiply with the 27 which was made, then by 6 months over 12, and then we remove the dip, 1.5. So if you want, you can even just put them together in the same bracket. If you want, you can put them together in the same bracket, remove the 1.5. It should also suffer this one. So how much do we have here?
By 25%.
Yeah, how much do we have?
3.
We have 3. You see? We have 3.
Yes.
So we have our 3. Now, what are we going to do with the 3? The 3 was our NCI there. Was the non-controlling figure, 3.0. So you see, what is the profit we're going to give to the owners of the business? We are going to get 42 minus 3. What are we going to give owners? The owners of parent, how much are we giving them?
39.9.
We are giving them 39.9. Have you seen that? If we add 39.9 plus the 3.0, we are going to go back to how much?
42.9.
42.9. You see? That's what happens.
Yes.
The question is done. It's done.
Done.
It's a very, very easy calculation, but I must mention that you need a bit of practice to be good at these things. You need a bit of practice to be good. So let me just explain a few things here. Okay, so here, just to mention a few things that you must look out for. Just know how to treat intergroup trading. Because if you're able to see here, from the question, you can see that in this question, the parent sold. Now, when the parent sells, you must make sure you know where to take the URP. Because if you don't know where to take the URP, you're going to mess up out of figures. So please do some practice and make sure you watch, the other video on YouTube. Make sure you watch it for group accounts. Now that video contains a lot of adjustments for the SFP. It's a very good question. Make sure you finish it up. So that, so by tomorrow, I want us to do a question which is going to have both the income statement and the SFP in one exam. So I'm going to do tomorrow. So for now, this has been, this is enough for now. This is enough. So just make sure you go through and do a bit of practice. Okay, Daniel, thank you very much. Those of you following us on the other side, please, we want to mention that we will start tomorrow same time. Tomorrow same time, and make sure all of you go and watch this video. I'm going to upload it on YouTube, so make sure you watch it so that in case you forget, you can still go back and do the calculations. So thank you so much for joining me, and I'm happy to say bye-bye.
All right, boys. Sir.
Yes, yes.
Just wanted to ask on this is the last part of the whole syllabus, right?
Okay.
Or maybe there's still more.
Yeah, tomorrow we can discuss that. The last part is we've done. Group accounts was our last part for the whole syllabus, but there are some few things I want us to do together. I want us to be able to look at a few things on. I have a question I want us to do together before you go. I want you to do with me a question on earnings per share and financial instruments, so that
Right.
we're just comfortable. There's a question I've found a nice one. I want us to do it together.
All right.
So everything, the syllabus is done. Thank you very much. You people have been very much committed. It's been an honor to start with you. I'm so grateful. But let's keep in touch. Tomorrow we finish up the question, and then we can also do financial instruments and the earnings per share.
All right.
Okay. Thank you very much, Daniel.
Thank you, sir.
I'll be able to upload the question. Have a good day.
All right. Thank you. I'll be waiting.
Okay.